So I'm covering the most commonly asked questions before you actually purchase, an index universal life policy, also known as IUL, because it's very, very popular nowadays. So the first question is, what kind of life insurance policy should I get? That's the first question. Folks, the type of life insurance policy you need totally depends exactly on what your needs are. If you want to get a life insurance policy in the event I die, it's very simple. Then you simply buy a regular policy. So, a regular policy in this case could be maybe I buy a term policy. A term policy will be for a certain period of time. Say I buy it for like a 15, a 20, or 30 years. Maybe I have a loan for 30 years, maybe a mortgage, for example. I could buy a term policy for 30 years to serve that purpose, and then that's it, and then I'm done with it. But if you're looking to put money away for retirement purposes, if you're looking to put money away for, for maybe even to save for your properties, for example, because you want to invest to buy a home sometime in the future, or if you're looking for college education instead of 529 plans, you say, okay, I want to put money away in a place that I can use the money for either college or anything else. That will be the perfect place. IUA will work wonderfully for you. The next question: how much life insurance do I need? You see, the amount of life insurance you need depends exactly on what we call your income replacement capacity. So, what that really means is this: say, for example, if you're making $100,000 a year, the rule of thumb is this: is 10, multiplier, meaning this: take my income, multiply my income 10 times. If I do that, then essentially I cover my income for a period of 10 years. So when it comes to how much insurance do you need, there's a short formula for that. Call it DIME: debt, income, mortgage, education. So debt, like DEBT, simply means how much do I owe right now, so I can pay all of those things off: your credit card, your car notes, your personal loans, etc., student loans, etc. Then the second one is your income: how much money am I making, and how much income replacement do I want to put in place? Then the third one is your mortgage. So if I die right now, is my mortgage going to be paid off, or is my loved one have to struggle to keep making a mortgage payment? And then the fourth one is called education. So if I have children right now, it's very, very simple. If I die, are my children going to be able to go to college? So the A stands for the educational part of it, that allow the opportunity for you to be able to what? To have money in the event that you pass away. So that's that part right there. So your needs is customized completely to you. The next question is, how much does a life insurance policy cost? So life insurance policy is based on age and on health and on needs. So obviously, the more life insurance you have, the more you pay for it. It's the older you are, the more it costs, And so when it comes to the cost of insurance, it's truly about those things, including obviously your health. So if your clean health is cheaper, if your health is high risk, then it's more expensive. So there is no blank answer. It's like saying, how much does it cost for me to buy a car? It depends. You could buy a car for $15,000. You could also buy a car for $5 million. So it really all depends in that sense. I would say, contact the right person to get the appropriate quote for you. Now, the next question says, will my life insurance provide living benefits? Not all life insurance provide living benefits. Let me explain this. There is something we call a living benefits today that a lot of people are taking incredible advantage of. My salute to them. You say you could have a life insurance policies, and for medically covered conditions, your heart attack, your stroke, your invasive cancer, breast cancer, prostate cancer, any kind of invasive cancer, along with brain aneurysm, and the list goes on, that automatically, if those conditions medically diagnosed, then you are eligible for a portion of your life insurance policies to be paid to you while you are alive, by the way. So this is what makes this incredible. So we call that a living benefit. You don't have to die to use it. Not all insurance comes with that. You see, there are some life insurance policy automatically they are wired for that. that it comes with it. But some policies don't come with it at all. So it depends. If you're buying a life insurance policy, ask specifically, does this policy cover a living benefits? So some of those also include terminal illness, chronic illness, critical illness, and critical injury. They're all part of the living benefits coverage. It's amazing, by the way. Today, I think everybody needs to get a life insurance with a living benefits if you can, because one of the biggest problem today, apparently is what is medical costs, and that's a leading cause of bankruptcy for a lot of people. So it just makes sense that you do whatever you have to do to make sure that you have the appropriate coverage for yourself. The next question says, what life insurance benefits are guaranteed? Typically, your death benefit is guaranteed, if you pay the right premium, and so there are some life insurance policies that obviously, once the term runs out, is over. Like, for example, if you have a term policy and it covers you for 10, 15, 20, or 30 years, or even longer, the moment the period is over, that policy is gone. So there is nothing called guarantee anymore. It's over. It's of its purpose. You are alive. That's awesome. Nothing's wrong with that. But it's over. Then you have policies that are permanent policy. As long as you pay the premium, you have the policy for the rest of your life, and it's guaranteed. So again, the types of policy you have gives you the guarantee elements, of that. Typically, your whole life policy is typically guaranteed. The next one, the question is, when can I expect returns? All right, that's an interesting question. So, when can I expect return? So, if I'm putting money into a policy, and especially with today, it's more advanced policy, because today, I see clients put in a down payment, 100,000, 500,000, even $1 million into their policies today. So it's like you put the money down, have access to the money. It's almost like you're using your bank, your life insurance like a bank. So you put money in there, you can withdraw the money when you want. You could pay yourself back when you want. You gain interest, and the list goes on. So let's say, for example, you need to buy something, big ticketed item. So instead of going to the bank to borrow money from the bank, being charged interest rates, automatically it can be done that the money can be borrowed exclusively from your life insurance policies. Then you pay yourself back, you fund yourself. It's an amazing philosophy, by the way. I highly recommend that for everybody. So in this type of policies, like your index universal life policies, for example, like it gives you the flexibility. That's why people like it. So you can contribute more, you can contribute less. You can increase the face amount if necessary. You can reduce the face amount if necessary. And so it gives you the flexibility. That's why some people tell you it's probably the only one you need for the rest of your life, because it adjusts to your life situations. Now, having said that, you could have your money, in the account that you can withdraw money right away, if you put down a large sum deposit. Now, let's say you didn't do that. For most policies, they run for about a couple of years, 2 or even 3 years before they start building money that you can take out. Because the first few, you're paying typically for the high cost, if need be, of your coverage, assuming that you have, a very large volume of insurance coverage, and then you start building a lot of cash at the back end of it, because the cash value has grown for you. There's a compound interest on it. It helps as a hedge against a future rising cost, allow your money to work even better for you. So, the return could be a lot sooner. Again, depending upon how much you put into it. Now, the last question, what if my health changes? Once your health changes when it comes to life insurance, you don't have to worry. Life insurance is based, on the date of your application, which means the day we start to underwrite you. What does your life look like? What does your health look like? So once you have been approved and they say you're good to go, your life insurance is good to go. So if your medical situation changes afterwards, the insurance company cannot take the money from you, because the agreement is this, that you came into the contract in good faith, and the insurance company have to respect the contract, because the contract of life insurance is called a contract of adhesion. That means one party wrote it, and the other party adheres to it. So guess who adheres to it? You did. who wrote it, the insurance company. It's also called a contract, one is called a contract of adhesion, and the other one is also called a unilateral contract. So unilateral contract simply means it was written by one party. That's why it's unilateral, and so that's why when you go, who wrote it, by the way, the insurance company. So anything in the contract is more interpreted against the insurance company than against the proposed or the insured. Why? Because it was written by one party and the other party simply adheres to it. So your responsibility largely is make sure that you pay your premium. As long as you do that and you are fully disclosive of your information at the point of the application, you have zero to worry about. Okay, even if your health changes in the future, you're good. So, ladies and gentlemen, all I will say to you is this. Okay, a life insurance today has become the chosen tool for a lot of people. The wealthy have been doing this for quite a while. Okay, so your Rockefeller back in the days, I mean, literally perpetuate wealth and continue to incentivize good behavior through the use of life insurance policies, of course, intertwined with trusts. Same thing, your James Cash Penny, also known as Jesse Penny, borrow money from a life insurance policies like this, to take care of the employees, where they were in trouble, that they couldn't make payroll. But the Walt Disney did the same thing. The list goes on and on. So this is not a new concept. Maybe it's new to you, but the concept is not new. If you want to know more about how these things work, and you want to learn more about insurance, I've been in the insurance business, just so you know, for over 25 years. No, it's the only thing I have done. I know the ins and out of the insurance business. I have all my certifications, in the insurance business. So FSS, Financial Services Specialist, your fellow, Life Underwriter Training Council, fellowship, and so on and so forth, by the way. And just to mention a few. So my point to you is this. You're going to be dealing with a very credible individual that knows what they're doing very, very well. That if you ever have to come to me with any kind of questions concerning insurance, you can be rest assured that you're in good hands. So with that said, I hope that's helpful to you guys. And if you ever need to reach out to me, just shoot me a message, and I will respond to you accordingly. Bye now.